We have the variables that we're going to be entering are the stock symbol, the at-the-money straddle price, the range probability, the stock price, the implied volatility of the stock issue, and the historical volatility. Now, this is not a numerical, the historical volatility is not a numerical entry, but it is a judgment entry, and it's probably the only judgment entry that you're going to have. Let's take a look at another issue so we can get an idea of whether or not it's going to be a good candidate for our position, and we're going to talk a little bit more about the gamma scalping analysis that we're going to be using. Okay, let's take a look at a couple of issues and how we plug them into our gamma scalping analysis worksheet. Now, I've already got a few up here which I have pre-filled in, and what I want to do is I just want to show you, let's take AVP, which is Avon Products, and you can see from a historical perspective that the historical volatility is relatively low on this issue. Now let's take a look at some of the other ones on my trading list. Let's go to Amgen. It's probably, I mean, this is a judgment call, but I'd say it's probably in the middle of its range right here. Altera Corporation, it looks like it's probably in the higher end of its range. APC, it's in the higher end of its range. AFL, that's in definitely, Aflac is definitely in the high end of its range. Citigroup, definitely in the high end of the range. Bank of America, definitely in the high end of a very, very, very high end of a long range. The problem with gamma scalping in a bear market like we've had, let's take a look at the Dow Jones Industrial Average. We've been in a bear market, and historical volatilities are pretty high across the board for almost every single issue. So in a bull market, it's relatively easy to find issues that have low historical volatility. You want to buy options when historical volatilities are low, and that gives you an opportunity to pop if the Vega increases dramatically. When we do gamma scalping, it's very difficult to find issues in a bear market. I say difficult, but not impossible. Let's take a look at a couple others here. I went through Netflix. Let's take a look at Netflix. You can see on a historical basis, the Netflix historical volatility is in a relatively low area. So that's one issue that we can actually, looks like we may have some success with. If we take a look at the Qs, for example, let's take a look at the Qs. Again, the historical volatility is at the relatively high level compared to the previous 5 years. So let's talk a little bit about this analysis worksheet, and then we'll go directly into inputting some additional issues so you can see exactly how these are calculated. Basically what we do is we take the at-the-money straddle, the range of probability, the stock price, the implied volatility, historical volatility, and then we get what I call the range index, a cost index, and a profit index. All things being equal, we want the range in which the stock will move as high as possible. And you can see the Netflix range is 10.76, which is a little bit on the high level compared to the other issues that we're looking at. The cost index is simply a calculation of the at-the-money straddle divided by the cost of the stock, the price of the stock, divided by its implied volatility. And we get a relatively low cost index on that because there is quite a low cost compared to the cost of the stock itself. If we go down, there's a couple other issues that are also extremely low cost. For example, American Express and NAIHD, which we've already done an analysis on in this spreadsheet. But I want to take a look at a couple of other issues. We're going to take a look at Disney. We're going to take a look at Clear Channel Communications. And if we want, we can actually do a third here. Let's go ahead and do something like Broadcom, BRCM. Just so you have a feel of how to enter the information into the spreadsheet. Okay, let's go with Disney. First of all, we need to get the at-the-money straddle cost. So let's go over to our trade tab and enter Disney. The last trade of the stock was $31.10. So it's either going to be the $30 strike price or the $32.50, which is going to be at the money. Let's take a look at both of those. The $32.50 is selling for $2.33, and the $30 is selling for $2.35. So we might as well go with the lower cost of the two, which is, even though it's only 2 cents, it's still a little bit cheaper. Let's go ahead and analyze this as a duplicate trade. And remember, we are going to do 10 contracts. And let's spread this out so that we make sure that we have the August expiration in here. Now, once we're here, we can bring up our spreadsheet and begin entering some information. First of all, the straddle cost is $2.33. So we just plug in 233 here. The range probability, remember, we want the probability of touching up here, not the probability of expiration. The range here for this issue until the nearest August expiration is $27.46 to $35.05. If we take those two numbers and we subtract from each other, we have $27.46 minus $35.05. It gives us a range of $7.59. So we can go ahead and include this in our worksheet. The current stock price is $31.10. We'll just include that. Using a spreadsheet like this will help us become a little bit more objective and keep us out of trouble when we're doing gamma scalping. The implied volatility for the stock is 37.1%, and we have to calculate that in terms of decimal points, so that is 0.3710. And then what we want to do is take a look at the stock price in terms of historical volatility. So we'll go over to our profit chart here and we'll enter the symbol. And this is where we really need to make a judgment call.